In this video, we talk about tax advantages of owning real estate and becoming an investor. Here's an overview of all the tax strategies that you are privy to as you become a real estate investor. We'll discuss each one in depth. Number one is appreciation. Appreciation is when the value of your property goes up over time. Appreciation occurs when the value of your commercial property goes up over time because you've increased the net operating income. Over time, the value increases simply due to the economic factors in the marketplace, such as supply and demand and or falling capitalization rates. The value can also go up quickly when you find a property where rents are below market and you jump in to increase the rents. Talk about depreciation. Depreciation is when the value of your property declines because of wear and tear, or a term we call obsolescence. Obsolescence is a fancy word for saying that something no longer has the same value as it did because needs change over time. For example, a computer that you bought 15 years ago, even if it's in brand new condition, isn't worth the same amount as a computer you can buy today. In the same way, a property that was designed 30 or 40 years ago won't meet the standards that you're looking for in a property today. And so, of course, in real estate, this change in value is called economic obsolescence. Let's talk about paying down the mortgage. Another tax benefit is when you use the income from your tenants to pay down the mortgage of your loan or property. So this is really good here because not only are you increasing your wealth that way, but also the interest amount of the loan that you pay every year is tax deductible. The higher the loan amount, the more interest there is to deduct. This deduction is the reason it makes sense to leverage your way into a property. You can leverage by using a small amount of your money as a down payment on a property and then borrowing the rest from a lender. Sometimes you can even borrow most of the funds you need from the owner of the property through an owner carry agreement. And that's something we'll discuss at a later time. The last thing is called rolling over. And this is what we call the magic tool, basically, in real estate. Rolling over is when you take all your profits that you made from a property and roll them over into another property. This is called a 1031 tax deferred exchange. With real estate, you can take all the profits, of course, in the property, including the appreciation, depreciation benefits, and mortgage reduction equity, and roll them over by trading into another property. With this exchange, instead of paying taxes when you sell a property, you can take your profits and reinvest or roll it into another property over time. This is just like getting an interest-free loan from the government. So now, the biggest thing is, can someone be an investor or a dealer? So we're going to discuss the differences between that. So a dealer is someone who holds real estate for short-term resale purposes in the ordinary course of a trade or a business. And so this is usually, as a dealer, you're into building, rehabbing, and possibly flipping properties, buying and selling them as quickly as possible. And so that's what is determined as a dealer. An investor is a passive owner who holds real estate for long-term cash flow and appreciation. So now this is a big thing for a lot of professionals that are starting to get into real estate investing. You yourself may do something other as a full-time job, or maybe you have another business. But guess what? The IRS considers the amount of time you spend on real estate activities compared to the work that you do to be that you can also be called a real estate professional. By being a real estate professional, you're required that you spend at least 750 hours a year on real estate activities. Also, you can be considered a real estate professional if you own more than 5% of a business involved in real estate activities. So this means you could be a real estate broker, a leasing agent, an architect, developer, or run your own management company. Next, we're going to talk about the type of business entities for investors, and we're going to talk about some of the pros and cons that are involved in that. So first of all, let's talk about a sole proprietorship. Sole proprietorship is one of the easiest ways of putting together a business because it requires no organizational filings or annual paperwork. You don't even need to file a separate tax return. Instead, your business reports its income or loss on a Schedule C of your federal tax income return. So here's the disadvantage of a sole proprietorship is that it has little to no liability protection. Next, let's talk about a corporation. Corporations give you good liability protection, but in most cases, they aren't the best entity for holding real estate properties because of double taxation. They are taxed as separate entities, as a corporation, and then again at their individual rates. So corporations aren't that flexible, accounting-wise, or compared to LLCs that require, but are not limited to annual reports, board of director reports, and federal reporting. So sometimes you like to use corporations to either manage LLCs or to run businesses out of, but not to hold real estate. So here's my favorite, and which a lot of investors use, is called a limited liability company, or short for LLC. Limited liability companies are one of the best entities you can use for investing in real estate. Why? Because these entities give you a lot of flexibility with respect to dividing up the benefits related to a property. In other words, they allow you to divide profits and tax benefits unequally if you want to. For example, the high income earning professional may want to tap into more of the tax benefits than some of the other owners who may want to take more profits. Dividing tax benefits and profits unequally can be tough to do with a corporation. So if you need to do this, an LLC may be the better choice for you. LLCs are fairly easy to run. And the reason being is you don't need to hold annual meetings and you don't need to have as much paperwork as you do with corporations. And then last, we're going to talk about limited partnerships. A limited partnership is a popular form of holding real estate for investors who want to be limited partners. So for example, if you and your brother and your sister want to be a partner on a particular property just for a short period of time, maybe for a few years, and then sell the property, then a limited partnership will work great. They basically invest their money while having liability protection and limited liability from the partnership's debt, creditors, and lawsuits. A limited partner doesn't get to participate in the management of the business, but there is one partner, a general partner who assumes liability for the partnership's debt as well as controls the company's day-to-day operations. In most cases, the general partner is an LLC, which provides a layer of liability protection for him. LPs are properly used to attract investors who want to participate in the profits, but desire to limit their risks and want no part in the daily operations. So limited partners may be replaced or leave the partnership without it having to be dissolved. So again, in this example, if you have multiple partners and you're grouping together to get into a certain project, this is a great way to pull funds together, but also a great way for people to get the return from investment properties, but not have to deal with all the risk involved. Plus, you have someone designated to handle the day-to-day operations. So a lot of people can partner up and start getting a residual income by grouping together in a limited partnership. Of course, like I said before, many real estate investors like to use the limited liability companies because they're easy to start and good for liability protection. So now let's talk about the magic 1031 exchange. This is something that I love. And again, this is something that you'll use in regards to being a real estate investor. And this is a great way that when you're starting out, that you want to go ahead and upgrade from property to property. So the way that you do this, okay, this allows you to roll over money that you get from the sale of an old property into a new property while deferring paying taxes. Now, some of the requirements, at least the most important that you need to know, that you must hold the property at least 1 year and 1 day. And from that point, when you sell your old property, okay, you have about 180 days from the old sale of that property to close on your new property. Also, it's included that you have about 45 days to where you have to provide a list to show the list of properties that you're considering, because this goes to another person that's going to go ahead and approve that property for the exchange. When you're involved in a 1031 exchange, you can sell any type of investment property and buy any other type of investment property. So one of the advantages is that I can go from selling a multifamily unit and I might want to go to a bigger warehouse. Or maybe I want to go from a multifamily unit to maybe a factory or maybe a retail space. The biggest thing that works for the 1031 exchange is that you definitely have to first, the property that you're selling has to be less in value than the property that you're purchasing. In other words, it needs to be cheaper than what you're getting, because what the 1031 exchange will not allow you to do is take any money from the sale of the new property. So it's effective the most when you have, let's say, a loan that you want to pay off. That loan has to be, has to take up most of the value of the newer property. So when you have that one, the loan that you're getting on the new property has to be bigger than the one that you had. Okay, so again, you can't profit from these, but what it does, ladies and gentlemen, is it keeps you from paying those capital gains taxes, which comes out of your money when you have the sale of your property. So just imagine if you sold a property and you ended up having $1 million profit from there. What you can now do is, instead of getting taxed 33% on that, which would mean almost $33,000 on that $1 million, then what you can do now is, I'm sorry, $330,000 out of that $1 million. Now you can go ahead and take that whole $1 million and you can go ahead and apply that to your brand new property. So if the new property is $5 million, how would you like to take $1 million chunk as a down payment and put it down tax-free on your new property? So that's the magic of the 1031 exchange, which is an excellent tool to use. The last thing I want to close with is always consult with your CPA or a tax professional. I want to put a disclaimer in and let you know that here at DKS, I am merely an educator and an instructor here to guide you as far as which direction to go in your real estate investment course. I am not a licensed CPA. I am not a tax professional. And so here, we only provide information to guide you on the right path. Please make sure that you have an experienced CPA or tax consultant on your team. This is so important to make sure you always stay in legal compliance with the IRS. Never assume that you know all the tax laws on your investment properties, because, ladies and gentlemen, they constantly change from year to year, okay? It pays to pay up front for great help than to pay more for ignorance. This concludes our video, and thank you so much for being a part of our real estate education course.